Good afternoon, cocksuckers. How's everybody doing? I hope the answer is well. So I came across something really interesting, really profound. I was looking at flow activity on any of these tickers that have earnings this week, and I came across a chart on UnusualWhales, which I do have an affiliate link if you want to jerk me off and sign up with that, or you can just go to UnusualWhales.com and I'll go fuck myself and not get the affiliate clout. But there was this chart for total open interest, and it really stood out to me because I saw these massive declines that were popping up in AMC and GameStop. And when I went to the charts looking at when these drop-offs happened, which this first one takes place on July 20th of 21, and the second is January 25th of this year, 2022. I went to the charts and found that that takes place at this white line and this white line. And I thought to myself, that's pretty interesting. Well, if we were to take a year back and look at what that looked like, or 6 months back, rather, you see the massive run-up in January. And then by the end of July, everything ceased, everything stopped. And then out of the blue, August 25th rolled around and we had a massive run. And then, holy fuck, Batman, that kind of looks familiar, doesn't it? So I've always had this suspicion that the options chain has a lot to do with what's going on with the fractal and cycle theory because, well, options are the one financial instrument that are able to quantify and notionalize the value of time. This is what we know as theta. So I started to just mess around with the chart, and I took some bars patterns, and holy shit. I'll get rid of this one right here. Okay, so I took the bars pattern of January to July of 21. That's what is here. And copied it, which is to the right of it, right here, and decided to just do a little comparison to see what it looked like, and holy fuck. Interessante. So then I started putting two and two together and dug into the option chain a little bit more. So here we have the adjusted closing price of GameStop in blue, and the red line is the volatility change as a percentage, the 30-day volatility. And if you take a look, we have a spike on February 24th and August 24th, which is 6 months apart. Well, if August of 21 was 6 months ago, almost now, then where would that put us 6 months into the future relative to August of 21? Well, February, interesting. And these spikes are not by any means a coincidence, because when you put together some of the rollover dates as well as some of just implied and historical volatility metrics, you do have this reverberation taking place. And my thinking is that max pain is taking place at every interval of time possible. Basically, if you were to take the same image of whatever, like what you're looking at right now on your screen, and adjusted the resolution, you would still have the same picture, whether you're at 1080p or 4K. The only thing that changes is your pixel density. So I think that if you take this analogy and you start using that with time instead of pixels, you're taking intervals of time like hours, minutes, days, etc., and proportionalizing those throughout the chart, and taking the changes in verticality and applying them based on that scaled change of time. So I started to do that. And what I've done, and excuse how messy this is quite the fucking thing to look at. If you take the cycle of January to July, and then insert the June run-up as the precursor, so this is the start of a new cycle, June to present day, I've denoted these as such, where you take this particular pattern that seems to be echoing throughout time and price. I've denoted it via these three golden dots. You have this very obvious signature of a pattern taking place, right? So up at the top, we have January to July. I just fucked that up. Dude, what the fuck? Thought I was going to do one take. So you take the top chart, which is January to July, June to now. You have a very interesting, to say the least, picture being illustrated And it's nearly to scale. There are some changes going on here. This is just noise from there being more than 1 or 2 market participants going on here. And hopefully you can see this okay. This is what we've come to know as, Wyckoff distribution and accumulation just being thrown back and forth at each other. But you also have this just very odd correlation taking place where price movement is very resemblant as that of which it's being compared to, which are almost a year apart. So then I decided to dive into the short interest, which I have represented here. I know that short interest is not what it should be. There's obviously some hiding going on, some, weaseling via advanced financial instruments, be it derivatives or swaps or what have you. So I know that these are not, these metrics are not what they are. I understand that there is something weird going on here, but as far as the industry, this is conventional. This is straight from FINRA, so take it for what you will. But even based off of the sliver of information that we really have, based on what is self-reported by self-regulatory agencies, because that's a great idea, you even have a pattern of the short interest and the way it's been moving around. These are not to scale, or they are to scale, but these are not the same values. They're not one-to-one. But you have the same pattern going on here that you can scale and shift and feed your own hopium confirmation bias or what have you. You see these heartbeats, these rhythms that again take place at such interesting times. You make of it what you will, but either way, it's undeniable that you have these correlations taking place that are so uncanny. It is very cyclical. It's very episodic. You can see it right in front of you. This is what's happening. So, okay, short interest is lining up. The options activity is lining up. The price action is lining up. Well, what can this be denominated to? How do you interpret this? So here's my postulation here. Here's what I'm asserting. I think that max pain is taking place at every interval possible. Back to the screen resolution analogy that I was giving of no matter what you're looking at, just because you change the pixel density doesn't mean that you're actually changing the image. You're just changing the representation of it. So I think that if you have max pain navigating the way it is at whatever interval you pick, so let's say that you have max pain at X from 1 week from now, the path to that price target is composed of smaller increments, so daily chart patterns or hourly chart patterns that will eventually create the entire image of going from where you're at in the present to max pain of 1 week from now. I think that is taking place at every time frame possible. I think that's what's going on here. I think it's a symptom of concentration and liquidity and the lack thereof because the bid-ask spread on this stock is fucking egregious. I think that it's also a concentration of algorithmic trading. I think it's also a concentration of corruption taking place via prime brokers and any other financial institution that has their hands in this. The float has been traded dozens of times over. Same thing for AMC. It's very obvious that there is something wrong here, and I think this is one of the biggest leads that we've had to date. So take that for what you will. I will be updating on this. It doesn't matter what time frame you look at. You're going to see the same pattern repeating. It's you can call it all Wyckoff. You can call it, I don't know, accumulation, distribution, whatever phrase you want to use, whatever terminology, but it's all over the place. It's the same shit everywhere. It's all about how you parse that and what's your vertical to horizontal ratio throughout the day. And I think max pain is the answer, just as a gradient and granular metric. So I'm gonna leave it there. I will be back with more. Hopefully you enjoyed. Like, share, comment, fondle my balls, the usual.